The Bigger Picture with Ryan Huang.
Good morning, you're on the Breakfast Huddle. Let's take a look at the bigger picture right now in the markets. So far, the opening numbers across Asia pretty positive and taking perhaps the cues from Europe trading session yesterday. Of course, that was lifted by the results of the EU parliamentary results and maybe the Renault-Fiat Chrysler merger talks. So what can we expect in the markets today? To help us get the bigger picture, we have with us Han Tan, market analyst at FXTM. Good morning, Han. How are you doing?
Good morning. Hey, it's a real pleasure to be here. Thanks for having me.
It's our pleasure to have you. Well, let's get your take first on the market sentiment right now. Last week, it was rather weak before we get a bit of a lift last Friday. Where are we right now and what are you looking at in the days ahead?
Right. So I think there is this still risk aversion mode that is currently playing out in the markets here. You're looking at safe haven assets that have clearly been the flavor of the last few weeks, and they have been rather range bound, if I can say that. That's because of the heightened tensions between the US and China. So markets are really uncertain now as to whether or not they can push further out into risk on territory, or do we just stay whole and make sure we play our cards safe moving forward.
Okay, a lot of wait and see and investors on the sidelines. And one of the few events that did happen was the EU parliamentary elections over the weekend. We did get results coming in through the Monday. What are you taking away from the results? We did get the pro-EU parties pretty much still a majority, but a bit more fragmented because more parties now are in the pro-EU camp, and you did get a rise in support in the nationalist parties. Mm-hmm. That seems to have weighed on the euro somewhat.
Well, okay, the main takeaway that I'm gathering post-elections is that the EU establishment remains intact for now. Now, granted, the risks that you cited there, that adds to the political risk layer when it comes to the outlook on the euro. But I think markets have grown accustomed to the political noise and the political undercurrents out of Europe. So now with the elections done and dusted, well, granted the makeup of some of these governments for the member countries, that has to be tweaked moving forward. But I think this allows markets and traders to refocus on the fundamentals in the near term. And so I think that's where the US-China trade tensions that will feature prominently back on investors' radars.
So let's dive into the numbers in terms of the levels you're looking at. Right now, I'm looking at the euro dollar is about 1.19. In the early part of Monday, we did see it go up slightly above 1.12. What are the key levels you're looking at for the euro dollar?
Yeah, so that 112 level, that's going to be a key resistance level. That is a 50-day moving average there. So you do notice that over the last 12 months, the bearish trend for the euro dollar, that has remained intact. And we expect that to continue. Again, given that the external risks for the euro story, that remains tilted to the downside. So that 112 50-day moving average, that's going to be a key resistance. However, if euro dollar breaks past that level, then 113 then could present stronger resistance.
All right, we are chatting with Han Tan. He is the market analyst at FXTM. So Han, talking about bearish trends, I'm looking at the pound, and the month of May was not a very good month for the pound. It pretty much hit a 4-month low last week. And of course, we had more news coming out that weighed on the pound from the parliamentary elections for the EU. So we had pro-Brexit parties really making headway there. And that seems to have weighed on the pound. So where does it leave the pound as we wait for a new replacement for Theresa May and maybe eventually a conclusion to the Brexit episode?
Right. So with the pound, it's slightly different to the euro, right? Whereby I believe, broadly speaking, markets for the European story was look back at the fundamentals now, with political risk perhaps taking a back seat in the interim. With the pound, however, it's a different story. It's primarily driven by political headline risks. That's been the story for the last few years, and we expect that to continue, especially in the lead up to June 7th, as markets try and find out who will next helm 10 Downing Street. So with Theresa May, having announced that she will step down by June 7th, depending on how the Conservatives actually get that leadership transition into place. So I think that is going to be driving sentiment there, because ultimately what investors are trying to decipher here is, look, how much of a risk will no-deal Brexit present to them? Because recall in the past, not too long ago, Westminster has actually said that, well, they're going to vote against a no-deal Brexit. So that put a floor for the pound at about 130. Well, guess what? Now with the ever-fluid dynamics of the political scene in the UK there, if markets get the sense that the chances of a no-deal Brexit rises, that could put downward pressure on the pound.
Well, 130 sounds so long ago. It was trading between 130 and 133 for pretty much a long time. Now we're looking at 1.26 versus the dollar.
The good old days, eh?
All right, Han, let's talk about what Donald Trump's been up to. He's in Japan, of course. He had golf, burgers, sumo wrestling over the weekend. Then they had a joint presser around lunchtime, and he said the U.S. is not ready to make a trade deal with China. So that's keeping markets somewhat in the risk-off mode. What does this mean for the dollar?
So what this means for the dollar is that we can expect the dollar to be supported here given this risk-off mode that you mentioned there, Ryan. Now, on top of that, if you look at the dollar index, the euro accounts for more than half of the dollar index. So as long as there is these headwinds that are facing the euro economy, you can expect the dollar to remain supported. So broadly speaking, the U.S. economy, even though the latest PMI numbers have disappointed somewhat, still the broader narrative is that markets expect the U.S. economy to perform better than their other major developed peers. So as long as that narrative remains intact, we can expect the dollar to remain supported. Mid-97 levels, 98 has been a resistance level for the dollar index here.
Of course, one to watch will be the Thursday Q1 GDP numbers.
Correct.
We will be watching out to see if there's any revision downwards from 3.2%. Of course, Han, let's wrap things up with the Chinese yuan. It's been weakening since the start of May from around 670 to 695. Everyone's watching to see if it'll break 7. So far, no. But yesterday, China issued a stern warning. It's warned that those who short the yuan will suffer from a huge loss. So what does this mean for the yuan? Are you seeing any support there?
Well, we are seeing stability with the yuan here. Keep in mind that when you look at the daily reference rate that has been set, in recent days, it's been hovering at that 6.9 level. So it looks like we have been testing the upper limits as to how much yuan weakness policymakers can actually tolerate. So we expect some stability moving forward. Now, this should bode well for Asian assets as well. So it puts a floor to the sentiment surrounding Asian assets as a whole. But 6.9 seems to be, once again, that line in the sand that policymakers have drawn.
All right. Thank you so much for your time this morning, Han. We've been chatting with Han Tan. He is the market analyst at FXTM on The Bigger Picture.